Hello, Will. Great to see you. How are you?
Oh, good. Thanks, Jim. As you know, it's been a really busy period. Morgans has been working overtime on this, and I know you have as well.
Look, one of the big things that's come up recently that I wanted to talk to you about was the likelihood, and we're starting to see banks cutting dividends, and potentially followed on by other of some of the big players. My attention gets drawn to our self-funded retirees pretty immediately there, as we're constantly chasing around about a 5% dividend yield to help them maintain lifestyle income. Generally, that's how the portfolios perform to be able to achieve that. And we're also looking for a minimum level of growth without exposing them to a great deal of risk of at least inflation, if not more. So if inflation was 2.5%, we're really aiming for a 5% dividend and 2.5% growth in portfolio asset allocation with as least amount of risk as possible. So now that we're seeing a potential cut in dividends, it's concerning, and we want to go back to the drawing board and make sure we've got a good solid plan for our self-funded retirees in particular. In that line of thinking, Will, what's your thoughts around why this has come about?
I think we've really taken our lead here from overseas jurisdictions, Jim. So we are regulated in the bank area by the Australian Prudential Regulatory Authority. This authority has sent a letter to all our banks, a letter which says, when it comes to dividend decision making, please prudently consider your capital levels when making such a decision. And this basically gives the banks a bit of a get out of jail free card if they want to cut their dividends or if they want to skip their dividends altogether. This leads very much we know from overseas. So in the UK banking regulator has said to its banks, you shouldn't pay a dividend throughout this period. We also know that the New Zealand regulator has said to their banks not to pay dividends throughout this period. Now, probably what's not well known is the Australian Big Four banks are amongst the 10 best capitalised bank in the world, and the best capitalised bank in the world is CBA. So it was interesting that APRA didn't take a blanket, no, you will not pay dividends throughout this period. They said, make sure that you prudently consider your capital levels and the potential downside to that if you pay dividends over this period. So it's definitely come from overseas, but it hasn't been a blanket ban like we've seen.
We've seen ANZ cut their dividends a while ago, and most recently, of course, NAB has followed suit. What's your feeling around that? Are they needing to make those cuts? How are the rest of the banks positioned?
Okay, well, Commonwealth Bank, number one position in the world. We don't think that there's any need for Commonwealth Bank to raise capital, and we're pretty confident of a very decent dividend coming out of Commonwealth Bank. So they really are a cut above the rest, and it's important to make that point. Now, we've seen National Australia Bank only yesterday announce a $3 billion capital raising, and they're going to follow that up with a $500 million share purchase plan. So I'll come back to that in just a sec. But one point here, NAB raised $3 billion of capital. That took them 4 hours to do that. So 4 hours, $3 billion. There is plenty of money out there to support the capital of Australian banks if they need them. Now, I think that we were somewhat surprised about this capital raising. We thought that NAB might just defer this interim dividend and just pay a final dividend later in the year. And as I said before, APRA had sort of given them that get out of jail free letter on the dividend front. But NAB chose instead to do a capital raising and to pay a dividend. It's a severely reduced dividend of about 30 cents a share. They have cut that dividend by about 66% to come up with that figure. Now, I think they actually would have done an analysis of their shareholder base. And you made the mention at the start of this video, of retirees, self-funded retirees, dividend income being so important for them, around the 5% mark. I think that's exactly what the NAB board was thinking when they did this, Jim. So they thought, well, if we raise capital at this point, then we're well ahead of APRA's Tier 1 capital requirement. and we can pay some sort of dividend to our shareholders.
And franking becomes really important, Will, especially for our self-funded retirees with their income streams coming out of the superannuation pension mode requirement, the zero tax. I know you did some calcs when Labor was considering taking those franking credits away from us, and you showed very nicely that, you know, over a year that adds up to a quite a substantial amount of money for our self-funded retirees. And you can rely on potentially up to another 1% on top of that 5% dividend if that's what we've been able to achieve. So
look, that's huge, and it makes a huge difference over time. You know, you're earning more than 1% extra. You know, over 10 years, it's an extra 10% given back to you because of the franking credit system. That's some huge figures over time.
Yeah, so we're looking for healthy companies that are still paying good dividends with a good franking credit percentage. And there's also other big companies that we're sort of looking at that we don't think COVID-19 has really affected in terms of the demand for their services. So those are some companies looking at as well, companies like Telstra, Wesfarmers, BHP, etc. What's your viewpoint around those guys in terms of dividend yields moving forward?
Yeah, so you can certainly think that, you know, Telstra's business will have seen no effects, you know, from COVID-19. You know, in fact, you'd probably say there would have been more use of their product and services over this time. The one negative consequence is that Telstra has said, you know, if you have lost your job over this period and you have some trouble paying your Telstra bill, you know, any month over the next 6 months, you know, Telstra will not immediately pursue you or cut off your services for that. So there may be
the point is that it's deferred, it's not been waived. So that cash will come back into those companies, won't it? Yeah.
Yeah. So, you know, there is, you know, some sort of bad debts that will come out from that. But generally, you know, we don't expect to see a big hit to Telstra's revenue at all. Also in the balanced model portfolio that we use for your clients, you know, that have concern for income, other great businesses are sitting in there. Horizon, which is the old QR National, hasn't seen any drop at all in its rail volumes, has maintained dividend guidance over this period. That's been a more recent addition. There's also been Australian pipeline operator, absolutely no drop in income for them. We think their dividends are pretty rock solid. If I just read from the other list over here, Rio Tinto, BHP, pretty confident of their dividends as we move through this period. Wesfarmers, as you mentioned, you know, Woolworths, you know, those businesses involved with consumer staples or utilities, you know, a lot of their dividends are going to be maintained over this period. Sonic Healthcare should be all right, might be a little bit of a cut there. CSL, you know, once again, we'd expect that to be okay. Macquarie Bank, look, we would expect a reduction there, but not too much. But certainly, you know, big cuts coming from our major four banks, big cuts coming from any bank in our economy. If we can find good, large businesses, solid balance sheets, paying good dividends, then we can take some exposure there. And I think we can enjoy that capital growth and movement. Because don't forget, a share price can't go up unless people are coming in and buying it and are willing to pay higher and higher prices to push that share price up. So we want to be able to be in those businesses that are going to capture that attention, capture that money, and grow, you know, particularly as the outlook, you know, in the future gets rosier and rosier.
So we can chase then good returns and good outcomes from listed investment companies that are rotating their asset allocation towards those particular companies. We can locate those companies that haven't been affected in a major way by this thing in terms of their demand, and so that we expect their dividends to be solid. And we can look at some of the really big tier banks like Commonwealth Bank in particular to be able to provide some stability for us there. The other side of it, of course, is the floating interest notes that we know and love dearly, that have outperformed any other kind of fixed interest fund or ETF over the last period of time. Could you give me some conjecture on what you think will happen there?
Look, the capital raising that National Australia Bank did is a massive plus for these listed corporate fixed interest notes. It really is. It actually shows you, as we always suspected and we've always educated people about, that shareholders are going to get diluted. They're going to have their interests in a business diluted for the protection of note holders or debt holders in a business.
As a priority.
So the capital raising by NAB adds $3.5 billion to Tier 1 capital,
Beautiful.
Strengthens the capital position of the bank, which makes the notes in NAB safer. Plus, as soon as they say we're going to pay a dividend, under that circumstance, they have to pay their distributions. So we are very comfortable that all your major banks are going to pay all their distributions on the notes and not skip a beat. So dividends in banks will be cut by 66%, but distributions coming from notes will be maintained at 100%.
That's fantastic news.
Fantastic income outcome for us. The other thing that's so important is all these notes, when their due dates have come up, so there was National Australia Bank and Macquarie Bank in February, they had their notes purchased back at $100 a note. Yep. So that capital protective element that comes for us when the call dates come around for these notes
working for us.
Is still working for us, even though we find ourselves in an unprecedented piece of financial history, almost with a instant bad recession, sort of Great Depression on the table here. We've got this good news about distributions, and the capital preservation element, which comes about when the call date comes due, seems to be holding. So we think there's no issue with any note that we've been looking at being bought back at $100 at this particular stage.
Beautiful. Well, look, that's some really great news in terms of our hunt for income for our self-funded retirees and anyone in that category that's relying on high yielding dividends and with great franking credits. And also we've got good stability in the floating note markets still. So portfolio construction isn't such a scary thing. A lot of these headlines is just a call to action for us to make sure that we're looking at our client portfolios very closely to make sure that we're maintaining their minimum requirements. But our long-term viewpoint is always one of income stability, especially in the self-funded retiree space. So, mate, thank you very much for your support. I know our clients appreciate all the hard work that you do as well.